Welcome back to the Talking Hedge. I'm Josh Kincaid, capital markets analyst and host of your cannabis business podcast. So to my point earlier about stock buybacks, you can see this chart going back to 2009. Cumulative S&P stock buybacks have been at the heart of this bull market, if you will, which is really just kind of lining the pockets of executives so that they can get a higher price to earnings ratio by removing or limiting the amount of shares outstanding. That increases their earnings per share and gives them a bonus. So none of this has been good, and it's going to probably change the game moving forward. Nobody was ever buying stock buybacks, especially tech companies. Like, who in the right mind would invest in a tech company so that they can go out in the market and buy the stock back? No investor would be interested in that, historically speaking, except the greedy ones over the last 10 years who thought, I don't know, the stock's going up, might as well just keep investing. Same kind of mentality for housing prices. The greedy people are thinking, oh, my house is appreciating. Who cares of why? They're not really looking at it as a bubble or deterioration of the dollar. They're just kind of thinking that it's helping them, and so who cares? So corporate debt was a defining excess of the past decade's bull run. 40% of all corporate debt is at risk, with a shock only half as severe as a great financial crisis. Debt has subsidized the skyrocketing salaries of CEOs, and there's a reckoning of debt-fueled corporate greed that's going to come wipe all of this out. So what we're seeing is potential return outlook that's going to go from bad to poor. The 10-year S&P returns was coupled with the adjusted price to earnings ratio, and that potentially has a 15% drop. So we're seeing that U.S. equities are still expensive. The prospective return on U.S. equities remain poor, and they're often very little margin of safety. So just to be clear, I'm not telling you to buy the dip or sell the rip. There's a lot of opportunities anytime that there's a downturn with a lot of the volatility, right? The oversold opportunities next day probably have a lot of volatility to that. So you can look at most oversold stocks and then probably buy in at a decent opportunity if you're risky. But I'm not telling you to BTFD or sell the fucking rip. I am saying that this isn't your normal recession. So the market's not cheap. There are opportunities, but there's an article that says this is not your grandfather's recession. The talking heads on CNBC and Bloomberg would like you to think that there's going to be a V-shaped recovery that's going to be really quick, the fastest bear market in history, when in fact this is going to be 2 to 3 years at minimum, more of a W recovery that's going to take a few years to fully recover, if that's even a thing. It's not going to fully recover. But earnings per share will probably forever be changed because, again, the last 10 years were basically just a stock buyback program and quantitative easing. So government's just printing out cash over the last 10 years, and corporations are just buying stock back, as well as sovereign wealth funds. You can see Japan owns billions of dollars worth of U.S. equities, including Amazon and Facebook and Google, as well as the Swiss National Bank or Central Bank. They own billions of dollars worth of those shares as well. And so as they liquidate, you'll see a lot of those stocks go down. And who are they going to be the buyers? In the billions of dollar marks, we may never get back to what we saw. So last week's spike of 6.6 million in initial unemployment claims was higher than anything we've seen in a long time, if ever. And so the fastest unemployment at 17 million people in 3 weeks is going to have a very long-term effect. We saw a lot of people that were unemployed during the 2008, 2009 great financial crisis leave construction and other employment to go to become waiters and waitresses in the hospitality industry. And now that they've been shut down, where are those people going to go? They're going to go to grocery stores and Amazon and be essential businesses. Who knows? Previous to this last quarter, the worst downturn we saw quarterly was 8.7% in the fourth quarter of 2008. It could be 3 times that. So why is the market going up when all of these unemployment rates are coming out with really bad numbers? Why is the market going up? Well, that's a short squeeze. So when short sellers that are betting against the market have to close their position, that's going to push the market back up as they close their positions. So that's creating a giant bear squeeze. So we can kind of see this steep rally in global equities being a giant bear squeeze rally driven by panicked exits from short sellers that investors have accumulated during the downturn. And the FANG index being Facebook, Amazon, Netflix, Google are some of the most shorted stocks. So on this graph, you can kind of see the 2 pops from people exiting those positions, creating a spike in that price temporarily. So what do you guys think? Is the source of the rally in 2009 mostly from stock buybacks? I think it was. According to this article, U.S. firms have been the biggest incremental buyer of stocks in each of the past 4 years, with their net purchases exceeding $2 trillion. For much of the last decade, companies buying their own stock shares have accounted for all net purchases. The total amount of stock bought back by companies since 2008 have exceeded the Federal Reserve's spending on buying bonds over the same period as part of quantitative easing. Both pushed up asset prices. So, in other words, between the Federal Reserve's injecting a massive amount of liquidity into the financial markets and corporations buying back their own shares, there was effectively no other real buyers in the market. And a lot of that debt that was taken on by corporations weren't used for mergers or acquisitions or capital expenditures, but just for the funding of repurchases and dividend issuance. So think about that. If you're going to be investing in Amazon as a technology company, are you doing that so they can go buy back that stock at a more expensive price just to increase the earnings per share? What does that do for you? Does it create any new products? No, it just helps the CEOs and the people in C-suite executive positions to get their bonuses. That's it. And no, buybacks are not shareholder friendly. So the reason that companies spend billions on buybacks is to increase the bottom line earnings per share, which provides the illusion of an increased profitability to support higher share prices. Since revenue growth has remained extremely weak since the financial crisis, companies have become dependent on inflated earnings on a per share basis by reducing their denominator. So as this chart shows, the earnings per share have risen by over 270% since the beginning of 2009, with revenue growth barely eclipsing 60%. The real beneficiaries of share purchasers are the insiders, changing compensation structures, becoming heavily dependent on stock-based compensation, with insiders regularly liquidating shares that were given to them as part of their overall compensation structure to convert them into actual wealth. And even SEC research found that a lot of corporate executives sell significant amounts of shares that they own right after companies announce a stock buyback. So, which should come of no surprise, as the corporate stock buybacks were hitting an all-time high, so was the corporate insider selling. So the misuse and abuse of share buybacks to manipulate earnings and reward insiders has become problematic. Furthermore, share repurchases at the least best use of companies' liquid cash. Instead, the cash was used for a one-time boost to earnings on a per-share basis. And now that all the companies have spent the years issuing debt and burning their cash and buying back debt, they're now begging for government bailouts. Boeing spent $60 billion buying stock back. Now they want a $100 billion bailout. Major airlines spent $19 billion repurchasing their own shares over the last 3 years. And now with coronavirus virtually paralyzing the travel industry, these companies are all in deep financial trouble, looking for the federal government to bail them out. So stock buybacks have fallen in recent months, right at a time when they've been the cheapest they've been in over 10 years. So it makes sense at this point in time to buy your shares back, but now they don't have any money. So go figure. In fact, the corporate buybacks have fallen significantly. 75% announced buyback programs have been canceled. And this chart shows the S&P buyback index versus the total return. So following the financial crisis, companies began to lever up their balance sheets to increase the stock buybacks. And there was a marked outperformance by those companies leading up to the crisis. So they had a higher return as they were buying their stock backs, artificially increasing their stock price leading up to the crash. So with this exodus, there could be a $50 billion further outflows from the retail community, as well as 50 companies in S&P that have already suspended their share repurchase programs, which accounted for over 25% of the buybacks in 2019. So the slowdown in buybacks could result in $300 billion of lost inflows over the next 2 quarters, according to HSBC. So the Fed just announced that they were going to buy double B or high yield or junk bonds. They're going to provide $2.3 trillion to support the economy, as a record 17 million Americans have filed for unemployment in the last 3 weeks. So last week, that was an additional upward revised to 6.8 million in initial claims. This week, there was another 6.6 million claims, almost exactly their expectations for last month. So that 3-week tally implies the unemployment rate of about 13 or 14%, surpassing the 10% peak reached at the wake of the last recession. So as these banks are getting bailed out, you see that JP Morgan is going to halt all non-government guaranteed small business loans. I think Wells Fargo is as well. So the Federal Reserve announced its latest series of sweeping, unprecedented actions to back up the credit pillars supporting the entire economy and provide as much as $2.3 trillion in additional loans during this pandemic, including starting programs to aid small and mid-sized businesses, as well as the state and local governments. Maybe they should be giving that to us directly, because once they give these to the banks, it doesn't trickle down. Trickle-down economics hasn't worked since Reagan tried to initiate it. So the fact that they're still doing this is just taking our tax money and just printing it and giving it straight to banks. So not really helping anybody, but I guess they're just going to have to keep banging their head on the wall until they figure that out, or until we do something about it. It's probably more realistic. So this is very reminiscent of the last bailout, where the banks just got a ton of money and individuals got absolutely nothing. So initially the Fed said it's going to buy investment grade bonds. Now they say they're going to buy high yield or junk bonds. So it looks like the U.S. is kind of following pace with Japan. Japan owns 80% of all of the ETFs. Those exchange traded funds or indexes, Japan owns 80% of them all, just to prop up the market. So it looks like the Fed is now directly buying in stocks. And so it's just a matter of time before the Fed unveils it's going to start buying the SPY or the S&P index. Again, just kind of following suit with Japan to prop up the economy with taxpayer money. All right, we're going to leave that one right there and revisit it another time. So with that, we're going to roll this one up. I'm Josh Kincaid. This is the Talking Hedge. Don't forget to like, share, and subscribe, or don't. And I'm out.